Hello, everyone. Welcome to the webinar, How to Reinvest Tax Credits into the Front End of Innovation. My name is Yunshen Yu, Senior Director here at Lux Research, and I will be moderating today's session. Presenting today is Dr. Ari van Berkel, Chief Product Officer here at Lux. Now, throughout the webinar, you can type any questions you have in the questions box on your screen. Time permitting, we will answer all the questions that we can. If your question does not get answered, please do not hesitate to email it to questions@luxresearchinc.com, and we will get back to you shortly. Now, if at any point you experience technical difficulties, such as a frozen screen, simply refresh your browser and check that your internet connection is strong. Now, let's begin our presentation. Over to you, Dr. Ari.
All right, thank you, Yang-Sheng. And welcome everybody to our webinar. Good morning, good afternoon, or good evening. Thanks for joining us for everyone's favorite topic, right? Taxes. This is going to be, and that's not a US state, that is something you pay to the government, right? So we're going to be discussing tax incentives. My goal today is to help you understand why these exist and how to benefit from it. And I have a couple of suggestions on how to use them as part of your budgeting. And this is part of our ongoing series on innovation strategy. We talked about weak signals and defining your positioning and defining your roadmap. We talked about road mapping, and just recently we talked about planning for execution, creating your organizational design. And part of that is deciding what you do, where, and how. Are you doing everything in-house, using your own R&D? Are you collaborating in an innovation ecosystem that will maybe give you more excellence, or it will give you leverage, but it may give you less control? We discussed all that. We also recently, Anthony Schiavo presented to you about innovation clusters, which is one way to collaborate in the ecosystem. And today we're going to take a look at tax incentives, because tax incentives can also play into how you organize the projects that you want to get done next year. Now, those tax incentives don't only apply to your organization, they also apply to organizations you work with. And that is important to note, because there will be some remarks about that later on in this webinar. What are we going to do? We're going to start with the country and policy perspective. So there's no free lunch. If you get a tax credit, then the entity, the government that is giving you the tax credit, probably has some sort of purpose with it too. So if you're getting the gift, you probably need to know why that exists to begin with. So we're going to take a look at why countries are doing it and what kind of tax incentives exist. And this should give you a framework on how to think about it. Then we're going to take a look at the perspective of the company, which at first glance is really simple. It's you get a break, right? You get money, so you get a bit of support in your innovation, but we can say a bit more about that. And then finally, we look at what it means, how to deal with it. All right, so why do tax incentives for research, development, and innovation, RD&I, exist to begin with? So we're only talking about tax incentives in this webinar. There are other incentives. There's research grants, for example. There's direct funding of R&D projects. There is funding of universities and public research organizations. So all of that also exists. We're going to touch upon it lightly because it's part of the context, but we're not going to discuss it in this webinar. We only look at tax as a way to incentivize research, development, and innovation within private companies. And the purpose of those is always to increase private investments in innovation. So there's only one metric of success for any government for whether tax incentives work or not, which is, do we get more RD&I investments from private companies than if we were not giving those incentives. That's fairly simple, but why is that so important? Well, there's a host of research on it. You can see here a picture of the ASML headquarters in Veldhoven, near Eindhoven in the Netherlands. I find it an interesting picture because what you can see is the large building, which contains all the offices, and then you can see lots of lower, like five-story buildings next to it. And you can see there's a whole train of these buildings, and basically it symbolizes the expansion of the company over the past years. And this is purely R&D based. They develop a product that is extremely R&D intensive, and as a result, they're very successful. And by now, they're one of the biggest, if not the biggest, tech company in Europe. So research and development can create a lot of economic activity. And in fact, if you look at some recent research, there's research by the National Bureau of Economic Research in the US that states that the social rate of return of private R&D investments is 67%. What is the social rate of return? It means it's the rate of return beyond the scope of the company. So it's basically the impact of that private R&D investment in the entire economy by increasing productivity, by not only boosting revenues for the company itself, but also for its suppliers and its clients, etc. The UK government has also asked, in this case, Frontier Economics to perform a study. They have a somewhat more conservative view. They say the social rate of return of private R&D investments is at least 36%. But they also acknowledge that there exist studies that produce numbers, credible numbers, right, based on solid research and good methodology, up to 120% even. But they say at least 36%, that's the hard number they will commit to. And the research, slightly older research, like 10 years ago, you could see that the EU had a growth accounting report, which stated that 1/3 of the GDP growth in the EU was due to investments in intangible assets. Now, some of those intangible assets are things like goodwill, etc., but they don't really create a lot of GDP growth. So the intangible assets that drive this growth is investment in RD&I, research, development, and innovation. 1/3 of the GDP growth of the EU depended on those type of investments, which is different from investments in tangible assets like building a new factory and things like that. The German investment bank, right? This is the investment bank that was established to rebuild Germany after the war. So they've got by now about 80 years of experience. 10 years ago, they said the social rate of return of private R&D investments is between 40% and 90%. Why the big difference? Because it changes based on what kind of discount rate you take into the calculation. Obviously, if you have a high discount rate, it means that the present value of the economic growth is lower, and therefore the return of those R&D investments is lower as well. So let's take the middle ground, right? So we're getting back to roughly that 60% that the US agency also predicted. So governments are convinced that R&D investments by private companies within their country is an essential element of having economic growth within the country. And this is why tax incentives are both justifiable politically, because you're getting more tax revenue, actually, because GDP is growing. So if you give a little tax revenue away, you basically invest it to get a lot more tax revenue, and also essential. And most countries have some sort of tax incentive nowadays. Of course, that's based on the assumption that they actually work, that they promote more investments in R&D. There's one other ancillary consideration for governments, which is about the ecosystem. So here I want to point at the European Research and Technology Organizations, the RTOs, which are publicly funded organizations, but they're only partly publicly funded. And you can see some of the largest ones in Europe here on the screen. We're talking about organizations like Fraunhofer, CEA, SINTEF, VITO, RISE, VTT, and of course TNO, where I had the privilege of working for some time. There are many more out there. If you look at those research and technology organizations in the EU, they obtain between 30% and 50% of their revenue from private funding, from private companies. Why is that interesting? That means that the government is spending, say, €1. When the government is spending €1 on these organizations, they're actually getting up to €2 worth of research capacity. So they can maintain a much larger organization for only half the money. And this is really important because it feeds the ecosystem. So they have a large bench of both facilities and experienced researchers. But they don't pay for the whole bench, they pay for half the bench. And so you will see that some of those tax incentives, one in France, for example, are also geared directly towards tax incentives for working with these type of organizations. Same applies to universities. The more third money stream funding universities attract, the bigger your university becomes for the same amount of government investment in them. And therefore, the bigger your ecosystem is. All right, so what kind of tax incentives are there? Well, it is useful to distinguish two types of tax incentives, input-based and output-based. Input-based incentivizes investments in R&D, regardless of the outcome of the research. It just invests in it has a type of incentive for expenditures. Output-based incentivizes income from R&D results. So on input, you have tax credits on R&D expenditures, you have exemptions or reductions of income tax. The income tax is tax that you have to pay as a company for employees. So not income for the company, but income for the employees, wages. You can also have increased reduction of R&D expenditures, and there's accelerated and flexible write-off. And we'll show some examples of those. Output is some sort of tax break, some sort of tax benefit on the income as a company. So now income here is not for your employees, it's your income as a company that you get from innovation and that you can show you get from innovation. There's quite a bit of research because, like I said before, for countries, it is important to stimulate R&D expenditure by private companies. And one way to do it is to use these tax incentives, but then you have to know if they actually work. There's quite a bit of research, and the research suggests that the input-based measures are very effective. And for every 10% of stimulus, every 10% of tax incentive, you gain about 10% of private R&D expenditure. That is the consensus in the literature. So these work really well. Output-based incentives are a bit more debatable. And there are some indications that they do provide some benefits for example, in retention of labor and production capacity associated with the innovations. But it's not really clear how well output-based incentives feed back into private R&D expenditure. So there's a bit of a debate there. It's less clear, and you will see that there are less tax incentives there as well across the world. So let's look at some examples, right? A tax credit on R&D expenditure. A tax credit here is a direct payment. The government is just giving money whether you pay taxes or not. So even if as a company you're not successful and you're not making a profit and therefore you are not paying any corporate tax, you will still get the tax credit. The government will just wire money your way. And some examples here are Austria, which has a 14% tax credit on in-house and outsourced R&D expenditures. So if you, as an Austrian entity who pays tax in Austria, can show that you spend, let's say, 500,000 on R&D, either in-house or by paying universities, for example, you will get 14% of that amount just given to you directly by the Austrian government. Now, France has a 30% tax credit, so more than double Austria, of course, but there's strings attached, there's limits. And the limit here is that the tax credit is on outsourcing with recognized research institutes. So if you spend money on a project with CEA in France, you will get 30% reimbursed by the French government through a tax credit. So this is kind of an additional funding to those research and technology organizations from the government, but it also ensures that this funding is fully aligned with the interests of the industry. So it's a clever way of additional funding, and again, this is geared towards the research ecosystem. So this is a way for France to not only stimulate private investments in R&D, but also to make sure that it benefits the French ecosystem and that they have a bigger ecosystem as a result and a more versatile ecosystem. You can also do a reduction of income tax. This is very popular, by the way, and this is something that is really interesting for you to be aware of because lots of countries are doing this. And notably, this is really interesting for companies that you work with. So for example, this is something that is relatively easy to use for startups and of course makes a big difference to startups. So how does it work? This is usually based on a project basis. So if as a company you submit a project for approval to the government and you get that approval, then the government will make you exempt of income tax or will reduce your obligations for income tax of the employees that are involved in that project. So in Belgium, for example, you can see that there's an 80% reduction of income tax and any social payments that you have to make as an employer for people that are involved in those projects. So this makes a big difference, of course, because income tax is quite high in Belgium. So basically, the people you employ for doing research are much cheaper. You could almost employ about 70% more people for the same amount of money now. Sweden has a similar system, but it only offers a 20% reduction. So there's a large variety in the amount here as well. But of course, especially for small companies, this makes a huge difference. And it's good for you to know for companies that you're working with. You can also, this is sometimes called a super deduction, where you can deduct R&D expenditures at a higher cost than they actually are. So Poland and Greece have similar arrangements where you could apply a 200% deduction of R&D costs. So if as a company you're spending, say, 10 million on R&D, you would normally deduct 10 million from your profit and loss. It's just an expenditure, so you make less profit. Poland says you can do another 10 million. So even though you didn't spend that money, you can reduce your profits by another 10 million because of this. Greece says the same. This is a highly popular one, especially a lot of Eastern European countries employ this one. Now, 200% sounds like great, like a great benefit, of course, but you have to keep two things in mind. This only works if you are actually paying taxes on your profits. So if you're not profitable, let's say a startup, if you're not profitable, you're not really paying taxes, and therefore this doesn't mean anything to you. And it looks like 200%, of course, is a big number, but it only affects your corporate taxes. So, and corporate taxes minimum is 15% nowadays. That's Pillar 2 of the global tax agreement, except in the US, which has a slightly different but more or less equivalent arrangement. So 200% means you only get a 15% of your R&D expenditures as a reduction in the taxes you pay as a company. Right? Of course, if this would be 300%, you would get a 30% reduction in taxes that you pay. 30% of your R&D costs, just to be clear. So you can see it's taxes. Things get complicated really quickly now. There's an increase of flexible deduction on capital investments for R&D. Right? So the US offers this, which is immediate deduction. So if you build a new lab, you can write it off in that same year, which of course gets you less corporate taxes. So you get kind of, again, roughly that 15%-ish benefit. Lithuania has a similar arrangement. They say you can write it off in 2 years, as opposed to normally probably 10 or 15 years. And finally, and this is the output-based incentive, which is an innovation income deduction. So the Netherlands has, for example, an innovation box, which means that revenue that you can trace back to some of your IP is subject to 9% corporate tax, as opposed to the regular, in the Netherlands currently is 21%. Right? So you go from 21% on profits that you make to 9% on profits that you make. Luxembourg says the first you only need to account for 80% of the revenue linked to IP. So, sorry, only 20%. You're exempt for 80% of that. So they give a 80% reduction of the tax rate, which is slightly better than the Netherlands, but more or less equivalent. There's a catch here. And the catch is also much debated. The catch is that there is now this global tax agreement, which says that Pillar 2 of that agreement says that corporate taxes should always be minimally 15%. So let's say you're a company in the Netherlands and you can trace all of your innovation, all of your revenue to the innovation box. Then you would say, okay, all of my revenue is subject to that 9% corporate tax. That doesn't work, because then the Dutch government will need to comply with the tax agreement and will need to say, well, but we cannot actually charge you a 9% tax rate. We have to charge you a 15% tax rate. So there's kind of a implied cap on these kind of measures. Are we all still following? This is the fun part of the text, discussing all the tax arrangements that exist, right? So now you have a good overview of what kind of arrangements are there. And in the output-based, it's also good to see what kind of IP is actually eligible. So you can see here the number of regulations that acknowledge this type of IP. So in total, we found roughly 14 types of output-based regulations, and all 14 recognize patents as IP, but not all 14 recognize software as IP, for example. And then there's plant variety rights, which is recognized by only 5, roughly. You have protection certificates, things like orphan drugs, so drugs that are part of your previous research, but now no longer IP protected, but you can still claim revenue as part of the innovation box there. But that's only recognized by about 3 countries. Industrial designs also hardly ever recognized, and of course trade secrets. Apparently 2 countries have figured out how to recognize trade secrets as part of your IP, even though it's secret. And then there's other things like codified know-how and all that, which is hardly ever recognized. Trademarks, there's only 1 country, and I apologize, I should have looked up which country exactly that is. I didn't. But apparently there's 1 country that recognizes a trademark as something that you can link revenue to. So you basically, anything you sold under that trademark would be eligible for the innovation box. And I think by now it's pretty clear to you why that's only 1 country. So let's switch to the corporate perspective. So now we know why governments are creating tax incentives and how they're creating them. Now, why would you care? Why are you even listening to this webinar? Well, research development and innovation tax incentives can help you reduce risk, obviously, right? That startup can hire an additional person at no extra cost. That's great. So that's a reduced risk, and it can speed up things. You can also use it to create a multiplier. So far, as it should be, I suppose, with tax incentives, we're making your CFO really happy. Reducing risk sounds like a great thing. Getting a multiplier on your investment also sounds like a great thing. But what's in it for you as an innovation leader? How should you be thinking about these tax incentives? So if you look at the obstacles for innovation, and this is something that we showed in a previous webinar, and this is from a survey about what are the main obstacles for innovation. And we looked at firms that do innovate and firms that eventually decided not to do the innovative project. You can see, regardless of whether they decided to do it or not to do it, there are 2 big obstacles that stand out, right? Lack of finance and perceived economic risks. So tax incentives really help, and that's how they work, really help to get more private investments in R&D by addressing these 2 main obstacles. Now, for you to think about these tax incentives, right, first thing is you need to know that the average return on corporate R&D expenditure is between 14 and 20%, and that's a conservative estimate. This is again from some of the studies I cited earlier, and this is in the corporate ecosystem. So this is the return not only within your corporation, but within your industry as a whole on R&D expenditure. And of course, whether you're successful or not depends on on how successful your particular projects are. But the industry as a whole experiences roughly this kind of return on R&D expenditure. And of course, it depends whether you're closer to the 14 or to the 20% of which industry you're in. When you think about using those incentives, again, we come back to a framework that we've presented earlier. It really helps to think about your innovation in 2 different categories. One is operational innovation, which is innovation that is an intrinsic part of your operations as a company. It's something you must do. You must develop the next generation of the equipment that you're selling. You must develop the next generation of your smartphone. If you don't, you are going to lose market share because the competitors are going to release new models continuously. So it must do innovation. The key metric that it should be measured by is efficiency. You must do this, so you need to do it at the lowest possible cost. And a tax incentive helps to reduce that cost, so it helps to boost your efficiency. The other type of innovation is expensive innovation, which is an investment into business growth. It is not something you must do, it's something you may do, and you probably want to do because you want to expand your business. And the key metric here is the return on your portfolio of activities. Tax incentives help you to achieve a multiplier or a hedge. Now, you shouldn't want to depend on tax incentives. So basically, these two key metrics, either efficiency or your portfolio return, they should be sound and healthy without the tax incentive. The moment you need a tax incentives to create these, to make these work, to stay within your benchmark of efficiency, or to have a portfolio return that is acceptable to your investors, if you need tax incentives to make that number, you should think again. So you need to build a portfolio of activities, either for operational or expensive innovation, that meets your key metrics without tax incentives. So what is the tax incentive for them? Well, how do you benefit from that? Well, in that case, you can start to build additional capabilities for your organization. So tax incentives, the way to think about it is you get some additional money, you have some additional financial capability built into your projects, which you don't need immediately to meet the criteria that you are required to meet by your investors and by your CEO and all that. But that you can invest into further development of your organization so that it will be easier in the future to meet those same criteria. For example, in operational innovation, can you use tax incentives to invest in additional and better facilities that will boost your efficiency in the future? Can you change from your current lab setup to automated lab testing, for example? For expensive innovation, can you boost that multiplier and that hedge in your portfolio? Can you do some additional activities that maybe are early stage and not that certain yet, but that can help you fill the pipeline for your portfolio? And the way to do that would be to engage with the ecosystem. So just an example of what is the importance of tax and what are we talking about? What kind of money are we talking about here, right? This is a real life example that I cannot share with you in detail because we have an NDA for this project, but this is a real life project where the project costs about 1.2 million. And this is a small and medium enterprise which is developing new equipment. So basically they need 1.2 million to build their prototype. They applied for a regional development subsidy at the EU and they got it. And they can stack tax incentives on top of that. So in this particular case, this is a company that's in one of those countries that provides tax incentives for wages, and it also provides tax incentives for out-of-pocket costs. So they can get a reduction of their cost of wages in this project of 70,000 euro, and they can get a tax credit of 150,000 for the out-of-pocket costs. And then they have the subsidy grant of 500,000 for the project. So the total project costs are 1.2 million to the company. Eventually, it costs 480,000 million, which is a multiplier of 2.5. And clearly, the subsidy grant is the biggest part of that. But they still have about 20% or so of the project costs in this case that are the result of tax incentives. So they can spend 20% on additional things that will enable them to make, and of course they can also give it back to their CFO, right? But let's not do that. Let's spend the 20% on additional things in the project that will enable them to work on the next edition of their equipment, for example, already, to work ahead on it. So in this case, what they could do is commission a project with a research and technology organization. The 220,000 that they would have available for that is quite enough to do that. And they would probably even get a tax incentive on that again. If they do it in France, they would get a 30% rebate on that. Or they could invest in additional facilities, research facilities for 220,000, which would get you a pretty good automated lab setup or an AI facility, for example. So to conclude, tax incentives create a multiplier on your R&D expenditure. And particularly input tax incentives reduce the overall R&D cost directly. But you should not depend on that for the profitability of your products, of your projects. Right? The tax incentives can help you build your assets. And we talked about this previously in other webinars. You need to think about your connections with the ecosystem as R&D assets. Right? So you have two critical assets for long-term R&D success. You have your own facilities, your lab, your people, but you also have your network, and your network is an equally important asset, and it doesn't exist overnight. You need to build trust, you need to know your network, you need to get them to feed you with ideas. So that building those assets means long-term collaboration with the right partners in those networks, and being in the good networks to begin with. Tax incentives are ways to build that into your projects. So use your tax incentives to either upgrade your facilities or build your networks. Right? So you can use input-based incentives to build the front end. Don't rely on it for your core innovation, but use it for building your front end. We haven't talked much about output-based incentives here. I think those are really difficult to leverage in your R&D portfolio. They are not a primary motivator. You're not going to convince anyone of doing a project by saying, hey, if we have a really good outcome, you can have a lower tax bracket later on. Right? Companies will just want to see revenue based on it. So they're not an additional argument for doing the project. And getting those revenues back, typically like 6, 7, 8 years after doing the actual project, is really hard to plow them back into your R&D, unless it's a real corporate policy. So with that, we'll conclude what is hopefully our most boring, because it's tax related, webinar of this year. And I'm really curious if there are any questions. Yang-Sheng, you should have been monitoring the questions. Let's see if they have come pouring in or not. I'm happy to take one or two.
Absolutely. Thank you, Dr. Ari. We certainly have a handful of questions that have come in. For those of you who haven't submitted your questions, we will now be taking questions, and you can type them into the questions box on your screen. Again, as mentioned earlier, if we do not get to your question on this call, someone from Lux will be in touch after the webinar. Well, the first one here is one I had as well when it came up, is which tax incentive is most preferable? think the question here is saying ones that target operational innovation or expansive innovation. How could someone choose between the two?
Right. So for that, so first of all, it should be clear by now that input-based tax incentives are to be preferred if you're an R&D leader to output-based. Obviously, output-based will happen and your accountants will go crazy with it and that will benefit your company as a whole. But for R&D, really look at input-based. Now, within input-based, there are two types of tax incentives that you need to distinguish. One is the tax incentive that you get anyway. And the other one is the tax incentive that only benefits you if you are actually paying corporate tax, which means if you're making enough of a profit. The ones that you're getting anyway are the easiest to work with for R&D leaders. So for example, the deduction on income tax, right? So you have to pay less tax on the wages of your employees. That is a direct benefit, which even appears directly in your budget, and it just allows you to either hire more people for the same amount of money, so within your budget, or to outsource some of the activities to third parties or universities, for example. The other one, which is more rare, is the tax credit, like they have in Austria or France. France is a really straightforward one. You outsource to one of their recognized R&D institutes, which means you directly get a 30% rebate. It's a direct discount on outsourcing to those institutes. That is also very easy to work with. The ones that are harder to work with for two reasons are the ones where you need to be paying taxes to have a benefit. They're harder to work with because they are after the fact and they're going through your entire annual report and all that. So it's hard to trace them as an R&D leader. So it's also hard to rely on them. They're kind of at least 1 year, probably 18 months delayed before you know how much effect they actually had. And of course, they only work if you actually make a profit. And now I know most companies want to make a profit, so most companies likely will. But for example, they're hard to work with for startups that are pre-revenue or pre-profit.
All right. Well, speaking of input-based and output-based, then I think I'll jump to this question here then. For output-based tax incentives, are there any strategies or approaches that you would recommend for RD&I in terms of optimizing those programs specifically for output-based tax incentives?
Right, so there's one aspect of output-based that is important for R&D leaders that we haven't discussed yet. And that is, if you remember the image that I showed, this one. In order for this to work, you need to build a really good IP portfolio that can be linked to your products. And this is a discussion to be had with your CFO, for example. So figure out where you would like to benefit from an innovation box, which country specifically, look at the rules and design a strategy to build a solid IP portfolio that will allow you to get those benefits and to have an easy, relatively speaking, easy life of also justifying them, because you have to convince the tax authorities, of course, that that revenue is tied to that IP portfolio. So, and this could influence your innovation strategy as well. This could help you agree on target setting for innovations, where you say, well, it's in your interest, the interest of the entire board of your company and specifically the CFO, to build this strong portfolio. And that's why we're doing these projects. So it's, in my opinion, a minor consideration, but it's an important one. So if your company is really into innovation box benefits, a company like ASML benefits greatly from it, for example. then mark this picture, look at what geography you want to benefit, and weave it into the arguments you have for building the portfolio the way you do.
All right. We have time for one more, and this question came in to the chat box in a couple different flavors, so I'm going to kind of paraphrase and put it all together. Ultimately, tax incentives are very politically sensitive, right? They're oftentimes tied to whomever is in office. So how do you build sort of a long-term ecosystem relationship given sort of the changes that occur on a normal cycle?
Yeah, so that's a fair question. I would say tax incentives are, maybe because they are so complicated, are usually affected only quite late or not at all with policy changes. So they're kind of under the radar. So you have that layer of protection, but let's not make an assumption that will help you. I think the main thing here is to use the money that you get in 1 year to really build a longer term relationship with your ecosystem. So the example I gave, the company that has now 220,000 euro to spend because of the tax incentives that they didn't count on in the original budget, right? So they have like 223 money, which is free money, which is about 20% of their budget. You could use that to start 1 4-year project with a university, for example. So you use the money from 1 year to start a 4-year project. If you do that consistently, of course, you're only expanding your ecosystem more slowly because now you're only working with one university, but you're building a long-term relationship with that one university. So you're expanding slowly but steadily in this case. And I think I would prefer that over, let's say, using kind of a cash book approach and spending the money in the same year that you gain it. Obviously, your company's budgeting and accounting system has to allow for that. Not every company is able to do that given their accounting system. But then again, accounting systems exist to facilitate the business. So if you feel that that's limiting your ability to do so, then you need to have a discussion about that.
All right. Well, thank you, Dr. Ari, and everyone for joining today's webinar. That concludes our webinar for today. The slide presentation, as well as the recording, will be sent to all attendees via email later today. And as you leave the webinar, you will be prompted to complete a survey on today's presentation. We would greatly appreciate any feedback you have to help us inform and improve our future webinars. In the meantime, take a moment and check out our upcoming webinars on our website. And thank you all for joining us, and have a great day.